Welcome to a video by Fully Informed Trade. My name is Alex, and Fully Informed Trade is just FiTrade for short. I got very little time right now, so we got to go through a ton of information on the markets right now immediately. First of all, dollar index went ahead and rallied substantially throughout the day, and it has had its pullback towards the end of the session, which is around 3 p.m. Overall, what you'll see is that the markets will have pulled back after the dollar index started its rally. Then once the dollar index pulled back, you'll start seeing commodities and stocks to rally back upwards. So let's go ahead and see if any of that holds true. First of all, Dow Jones Industrial Average. We got a short-term negative trend. So give or take, we'll probably pull back to the 20-day moving average, maybe the 50-day, and the 100-day moving average. And pulling back to the 100-day moving average is very unlikely. As you can already see, the 100-day moving average is below 11,000, and the last time we tried breaking below 11,000, that wasn't very successful at all. So let's go ahead and review the next chart, which is the S&P 500. Same story here. Percent K going below the percent D. We got a short-term negative indication of trend with the trade triangle technology. So pretty much the markets will most likely pull back on the stock indexes next week by give or take 100 points or so. That's my viewpoint on it, my total outlook on the markets based on what I'm seeing right now, based on the current indications of the trend. Let's go ahead and review the volatility index. Volatility index is starting to go up a little bit, and mainly because the stock markets, people are starting to think that the stock market might pull back a little bit. But overall, I wouldn't short the volatility index, and if you are short the volatility index right now, would be a good time to get out of your shorts. Cover your shorts right now. Stay on the sidelines in the volatility index. Wait for a probable relief rally, and then you can go ahead and short into the relief rally. And a relief rally pretty much looks something like this, and then it pulls back again. So pretty much, if you ever feel like it, start shorting again once you see a relief rally. Shorting it right now at these levels is pushing it a little bit. Alright, let's go ahead and review the gold market. The gold market, I see a head and shoulder pattern, and pretty much what happened earlier on in the day was at around 11 a.m. it continues to go a little bit higher. Now my only issue and my only problem with this is that the dollar index also went up at around 11 a.m. onwards. Gold and the dollar generally don't mix and match very well. So, the dollar index has already pulled back a bit. So, again, that being said, the gold market might take this as a little bit more positive. But, if the dollar index decides to make another leg or another push up, gold will end up completing its head and shoulder pattern that you can already see right here. So if it completes this head and shoulder pattern and you start seeing a trend down a little bit, people will take that as a very negative indication, and we could break below some major support levels below 1,330. But that's only if this head and shoulder actually completes. Let's go ahead and look at the silver market. Silver market, same story here, except it already pulled back after seeing the dollar index make its move, but now it's rallying just a little bit just because of the dollar index starting to pull back a little bit and start falling down in the markets right there around give or take at 3 p.m. it starts pulling back, and the silver markets at around 3 p.m. starts making its quick move upwards and starting its trend above the 20-day moving average and stuff like that. Overall, commodities just keep their strength for as long as the dollar index continues its downward trend. But if there's ever a reversal trend on the dollar index, you can kiss goodbye this rally in the commodities, the stocks, and pretty much the stocks and the commodities. Let's go ahead and review the REMX. And pretty much REMX is Rare Earth Materials Index, and pretty much most of the rare earth materials are owned in China. The only issue there is that China is pretty much the only producer of it, and right now they're breaking down on a lot of gangs that produce 50% of the rare earth materials out of China. The only issue with that is that if you reduce production by 50%, you make it really hard for technology companies to make LCD monitors, TV manufacturers, companies like Samsung, like Apple, all sorts of high-tech companies that produce high-tech components, the stuff that we use, the stuff that we want, the stuff that we crave. The stuff, basically the tech industry will have a negative impact for as long as rare earth materials stays in short supply because of this crackdown on rare earth material mining companies that aren't really companies but gangs in China and in mainland China for that matter. So overall, I liked rare earth materials back in December of 6 or somewhere around there. Towards the beginning of December, this charting software actually liked it somewhere around $20. And anybody who followed the indication of this chart would have easily made somewhere around 20 to 25% return on investment already. Now, looking at it now, is it still a great trade? Well, right now you see this embedded slow stochastic, and you see this market pushing up right above the percent K pushing above the percent D. But let's see if this is really a topping market. Let's go ahead and pull back and try to look at a 3-month or something more practical. So pretty much it's above the Bollinger Bands, and it's going to get back inside the Bollinger Bands most likely. And because of that, I can't really recommend this as a trade right now. But once it gets back into the Bollinger Bands and you start seeing the 20-day moving average start trailing upwards, because that's always what happens, once the 20-day moving average starts factoring in these new moves upwards, the moving average always moves higher with it. And you're probably going to see the moving average touch somewhere around $22.50 and $23 later on. And that's probably that would probably be a great time if you see the stock market pull back to the 20-day moving average. That would be a great indication of going ahead and buying back into it. Because of that, there are various companies like Molly Corporation. Molly Corporation, I'm not really going to pull up a chart on it right now, but pretty much Molly Corporation at the beginning of December, it had exposure to the rare earth materials, to gold, to silver. And Molly Corporation has been a great company. And it went from $30 all the way up to $50. And that's give or take 60 to 70% return on investment in the scope of a single month. However, right now, Molly Corporation, it does mine in the rare earth material index area, or the rare earth material area. But my only flaw with it is that it's already went up by 60%. Rare earth materials seem like they're going to pull back right back into the Bollinger Bands. However, the longer term trend is still higher. So Molly Corporation has pulled back by 4%. It could pull back by a little bit more if the dollar continues its strength. But if it doesn't, go back into Molly Corporation. Go back to the rare earth material index. That's the bottom line here. Bonds. Bonds are going to keep going higher for as long as these bond auctions are thought to be attractive enough to attract investors at a 4% yield on, I think, give or take a 30-year or a 10-year. I'm not exactly sure, but the main reason why the bond market continues to go higher right now is because mainly it's investors are finding it attractive, and over the shorter term, you're going to see this continued uptrend for as long as the bond market has an easy time auctioning out or selling their bond notes. Primarily, this applies mainly to the treasury market. However, people are finding corporate bonds to be a little more attractive these days as well. And that's because corporate bonds do produce a better interest rate than Federal Reserve or federal government, federal treasury bonds. Because of that, I think that the short-term trend on the bond market should continue higher. However, we do have an overall negative trend in the bond market. And because of that, I find that the bond market is going to be a short-lived memory, a short-term relief rally in an over the longer-term trend that's negative. So overall, give or take, if you're a short-term trader, it wouldn't be a bad idea to buy into this because of the the strength in the bond market. But over the longer term, if you're a bond investor, I'd sell into this relief rally, or that's just me personally, but that's just what I feel about the bond market. Short term is going to go up. Over the longer term, I feel that it's still in a downward trend, so it'll probably go down over the longer term as the economy grows, as stocks keep going up. People are going to find bonds less attractive, so they're going to buy stocks instead. Let's go ahead and review crude oil February futures contracts. And pretty much oil is continuing its highs, but right now it pulled back today after the dollar index went ahead and made its quick rally. Companies like ExxonMobil, Chevron, they've all made new highs as of recent. However, does that mean that they've made new 2010 highs? Will they continue going higher? Well, that's very dollar based, and if the dollar keeps weakening, yeah, you'll see ExxonMobil and Chevron and your U.S. oil funds and your crude contracts continuing higher. But right now they're falling down, and that's mainly because of the dollar going up. And if the dollar does continue its upwards trend, I would get rid of my crude oil future contracts, my ExxonMobil, my U.S. oil fund, my Chevrons, and all those other oil-based companies or commodity plays for that matter. Overall, that's all I feel like I have to say on the markets today. Please be sure to check out the charting software above or below the video. There's going to be a link for that. And be sure to keep on checking out the videos that come from me in the future. Thank you all for those watching on Facebook or YouTube. Take care, and I'll see you another time. Bye.